We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is John Feneck, founder and CEO of FeneckConsulting.com. Thanks for joining me today, John.
Sure, Tom. Thanks for having me back.
So when you were working at Sprott in 2016 and you started to run your own money, you said that the mining shares had really bottomed out at that time. So what was the market environment like at that time? And are there any parallels that we can draw to right now?
Great question. January of 16 was the low in a lot of mining shares that we were buying. And I've said this many times on other shows, but I really encourage your listeners to pick up the phone and call a CEO or just management in general at the firm when you have a scenario like Jan of 16, unfold, or really this summer. July and August of this summer reminded me of that kind of give up price action in a lot of these names where I was seeing a lot of people sell market orders into the bid. And it's like, wow, okay. I mean, it's really not a good idea with the kind of spread that we're seeing on some of these stocks, but some people just want to get out. And we saw that same kind of give up move in Jan of 16. And just to mention two names that I remember distinctly, Mitch Krebs at CDE and Keith Neumeyer at AG. I called both of those guys and I said, hey, the stocks look completely bombed out here. What do you think? And they both had the same response independent of each other, which is this is just a hold your nose and buy moment. So I did. And we were up 149% in 2016, largely in part because I was buying so heavily near the low, but it wasn't because I was smarter than anyone. I just felt like horrible every day. Like now I sleep like a baby. I mean, I feel really good about what I built. But back then I was like really nervous because, CDE crossed, I think, $1.50. And then you're wondering, is this thing going to go under $1? And then is it going bankrupt, right? Like it could have done that. I don't think in this environment, the plus side, Tom, is that you don't have a lot of BK, opportunities out there. Companies got cashed up last summer or this year, so they're gonna, be better stewards of that capital, I think. And we don't have that kind of crazy environment that we saw, 5-6 years ago. So, in essence, it's the same kind of, methodology that we use today. We pick up the phone, we talk to people, we act on public news, meaning if a company says, hey, our drill results are coming at this time, and then they push it back, I'll give them a call just to see what's up, right? I mean, it could just be the lab, as you know. It could be that their drill rigs are just not turning as fast as they would like. Maybe they're firing an operator. I just want to get to the bottom of it. Mm-hmm. But if it all sounds good, I'm good with the delay, and I'll relay that to my clients so they don't panic sell.
So, to kind of go back to what you're saying, that you're sleeping well right now, is that a good thing or a bad thing from an investing perspective for this market environment that we're seeing right now?
So my style is I grind every day. And if you look at my performance the last couple of years, I think we've demonstrated that we can beat the indexes pretty handily, at least in the last couple of years, in a really good market. In a really down market, I've had my troubles in the past, like in 17 and 18, I didn't perform as well as the indexes, and I've learned from those mistakes. And so how I would articulate that or illustrate that right now would be, we put a position on in BTG last, I think 3-4 weeks ago at 364, small position, but we took it out. We took away the position yesterday at 443. It's a 20% gain in less than a month, right? So like, I don't dislike BTG. I still own a lot of it, but we're going to take our, profits where we need to, make sure that we're not getting too cocky or whatever the word may be. We're going to trim where we need to make sure that if we're wrong about our thesis, and that thesis is that things probably bottomed late September, early October, then at least we're not going to get hit as hard. And I do trim also going into Fed meetings, just because the volatility, as you know, is extreme. So, I think the main thing to focus on as an investor is can you sleep at night with what you have, all the money that you have in the sector? Is it the appropriate percentage of your overall net worth? For me, I'm very heavily into the sector, just like a Dave Earthley is, like my buddy at Junior Miner Junkie. But that doesn't mean that's right for everyone, So typically will pick up the phone and talk to people about what their goals are, what their risk tolerance is. And as you know, many of these junior stocks are down 30 to 50 to 60% from last summer. So can you stomach a 50% loss? Like, that's something that most people cannot do. And so maybe junior mining is not for them, right?
Absolutely. So John, how are you working towards finding compelling stories in this sector to bring new investors into the space, new energy into this space? Why does this space look, appealing right now to outside investors when there are so many other opportunities?
So my background is working with financial advisors, and I'll tell you that I was at Precious Metal Summit. I went on Kitco on September 10th, and this is an interview with it that you guys can check out with David Lynn. And I said on the record, like, I'm surprised that there's not more financial advisors here. Like, this is like a 13-year rally. I would imagine that some contrarians or some value kind of advisors would be here. And I think there were two, which is just crazy to me. And that also speaks to the fact that this is a herd mentality right now, right? This is a market that's being driven into certain sectors, leading those indices higher, and also narrow breadth, in my opinion. So, like, when you look under the hood, what is actually driving the performance in the QQQ or the SPY? It's not as many stocks as the average investor would think. So I think this is a very dangerous, broad market here, in the sense that things just keep melting higher. And I think that is, just from my background, and I'll answer the question in a sec. I think from my background, that would indicate that portfolio managers are really greedy right now. They want to make their bonuses, which happen December 31st. And they're going to find a way to beat that index. And how do you beat the index in this market? You don't buy NEM, you buy Tesla. It's like you buy stuff that has go-go kind of momentum. And that's how you can maybe beat your index in your benchmarks. So to get back to the question, on your show last time, I did get some financial advisors from both Canada and the US contact me. And they said, hey, we'd like to learn a little bit more. One had 60 million under management, one had $1 billion under management. So, two totally different, backgrounds. But the one with over $1 billion was really compelling. They work for an excellent shop here in the US. They have 37 years of experience, and they were like, hey, we see a value in this market here, and we see the opportunity in the AEMs and the NEMs of the world. Can you help us? And so that was really interesting to me, that we're starting to see some more generalist investors and advisors start to perk up a bit.
So you've mentioned several times, John, that you're in constant contact with CEOs in the space. So how do you interpret a non-response from a CEO?
So I was on Brian London's show with Fergus Hodgson just recently, a few weeks ago, and that got brought up. And I mentioned a junior copper company that I emailed a few times and called once and got no response. So we just blew out of the position because I didn't like what I was seeing, and I wanted them to at least, give them the opportunity to talk about it. But the stock dropped at least 40% from our exit. And so, that's kind of what I bring to the table, is if people are not getting back to me, there's just too many opportunities out there, right, Tom? I mean, like, there's too many companies that are hungry to talk to me and talk to anyone. And so I just don't put up with it at this point in my career. 10 years ago, I would have chased someone down for that information, but I don't think we need to at this point. There's just too many good values. Mm-hmm. So yeah, that's kind of a red flag for us. If people aren't getting back to us, maybe they're on the road, but if they don't get back to us for 2 weeks, then, usually there's either news pending, which they cannot talk to us. They're in a blackout period, which is fine, but then just email me, you're in a blackout period, and I'll talk to you on this day. I'm cool with that.
Mm-hmm. So in that same vein, John, are you hearing from companies, something along the same lines right now? Like when you're speaking to all these different CEOs, are they having a hard time, raising money? Are they looking for takeover targets? Are there any, particular themes that all of them share right now?
Yeah. One unfortunate theme is that they can't get drill rigs out to their sites. Number one, and more importantly, number two, that their results are being delayed at the lab. And that delay is significant. I mean, it's been 4 to 8 weeks in many cases, sometimes more, for the average junior mining company, just beyond what they had anticipated and modeled for. So that's not helping prices right now. But I think there's going to be a lot of results coming in the next 4 to 8 weeks, and that will be positive for our sector. Another theme, let me think. I think just the theme I get is that people are surprised that gold sitting at 1,800, and let's say their all-in sustaining cost as a gold producer is 1,000. That 800 margins aren't attractive enough to the average investor, which I'm surprised too. I mean, if you remember back in 2011, something like Newmont NEM was trading at a higher valuation, but had thin margins, like maybe 150, $200. Now their margins are 800 on their conference call today. So what's up with that? Like, I think it's just lithium, Bitcoin, QQQ, all this stuff. Like, there's so many opportunities for investors right now. They're not interested in a stock like Newmont with a 4% yield even, which is sad but true.
Mm-hmm. So you mentioned earlier that we have, of course, the big FOMC meeting here next Wednesday, November 3rd. So what are you expecting coming out of that meeting? We know going into it that we're likely to hear something about the tapering schedule. So how do you see that, and what do you expect?
Yeah. So I would just start, before I forget to mention this, that non-farm payrolls come out the first Friday of the month. And so that comes out at 8:30 Eastern on November 5, and that will be meaningful. So I'm going to just caution people that it would be unwise probably to load up if you get a dovish Fed November 3rd late, because you might only get like November 4th to play that. And then if we get a hot non-farm number, like a high number, November 5, that may be a give back moment in the sector, because from my experience, GDX and GDXJ do well when we get a miss, and we've seen that September 3rd. We saw that October 8th. And so I'm hoping for, a lower number below consensus, because that would be 3 straight months then of misses in non-farm payrolls, which to me is something that the Fed is really hanging their hat on. Like, oh, look at all our employment, right? Well, the last 2 months have been pretty dismal. So is that transitory, to use a Fed term, or is that here to stay? And that is a bigger question. I think last Friday, with the Fed admitting that CPI has been hotter than expected and will run hot into 2022, was also very constructive for our sector, because a higher CPI coupled with a lower non-farm, that is not a recipe for raising rates.
So in that exact equation that you just spelled out there, John, when the Fed is continually basically missing the mark on inflation estimates, and we're combining this with our poor non-farm payroll numbers, does that point towards inflation continuing to run hotter and possibly leading to this stagflationary environment?
Possibly. Stagflation, as Dave Berkley has said, and I've said, is sort of, in our view, like a hot oil price running hot with CPI. And that's exactly the environment we're in. USO is a tracker for the price of oil. Check it out. I mean, the chart's beautiful looking. It's recovered fully from a lot of the February, March of 2020, move down. And it's been a slower ascent, which has allowed a lot of people to get in over the last few months. But couple that with a CPI number that's been hot now for 6-7 months, and that stagflation kind of like prognosis is real. That said, like, I would have imagined that when you have more of a taper, like you had said, like November 3rd is kind of like they've mentioned that taper is happening. It's no one's guess it is going to happen. That the broad market wouldn't have sold off a little bit on that. And it sold off going into the September 22nd Fed meeting. If you look at like something like the IWM or the QQQ, they sold off for like 7 out of 9 sessions going into the Fed meeting, and then rebounded really sharply. And that to me is scary, because that to me is exactly what I said. It's the greed of portfolio managers trying to eke out returns here, and maybe not doing the right thing. I realize a bonus is a bonus. I was bonused for certain firms I was working at as well. And, you try to do what you can, but you also have to be mindful of what you're doing. If you keep taking on all this risk, go back and look at the 08-09 crisis. Look at something like American funds. I'm not, singling this mutual fund company out, but they were found to have had multiple names like Apple, Washington Mutual in all of their bigger funds. Like everything of significance had a lot of the same top 20 holdings. So what happens when you need to get out? You're going to move the market. Like, what happens if Tesla, Apple, Amazon, some of these FANG stocks start going down in tandem with each other algorithmically? It's not going to go well. So that's what I would just caution there's a lot of people out there that, may have some mining money, but they also have their 401k at work, right? And when you look under the hood of those mutual funds or ETFs that you're putting most of your net worth into, got to be careful, because some of these things have more of a growth bias than you think.
Mm-hmm. So when we're thinking about this time of year that you're bringing up here, we have, on one hand, we have managers trying to beat their bonuses or beat their benchmarks to get their bonuses. But in this sector, we also have tax loss selling as well. So Is that something that we're going to see this year? You have some interesting thoughts around that. So could you share those with us?
Sure. So I've said for every year that I've been in this, on my own with managing money, overseeing money since 16, that it is a real phenomenon roughly from mid-October to mid-December that is very detrimental to putting on large positions. And we said this off camera, like there's a reason to leg into certain things, because if you just buy once or twice, those entry points could be flawed and then you're sitting on some losses, right? And so we'd rather leg into positions over multiple purchases just to get a blended cost basis. But we think that tax loss selling this year will be less detrimental if the Fed plays ball November 3rd. You have to watch that meeting, which, 2:00 Eastern, 2:30 Powell speaks. And if you get the all clear, meaning nothing out of the ordinary, you should be fine, between November 3rd and let's call it mid to late December. Tax loss selling might not be as bad, but if we get something that for whatever reason is hawkish, out of left field, then tax loss selling could be worse than expected. I can tell you from just watching the screen like a hawk in July, August, September, there was a lot of weird orders going on in some of these juniors where it was just really crazy. In fact, I had one that this week, went from 13 to 9.5 cents in a single trade. And I'm like, that was crazy. It was just a market order, and I was out there with a stink bid at 9.5 and got lucky. But there are things like that will happen. And so that's why we encourage people to not put one order out, maybe put 2 or 3 orders out and tier your orders so that, if you have a crazy sale like that during this time of year, which does happen, you won't get filled all at one price.
Mm-hmm. So John, I've heard you say before that you will get away from buying certain names that are contained within the GDX or GDXJ. So why is this?
So GDX and GDXJ, there's the GDXJ. If you look at a 5-year chart from the summer of 16 to now, you've made no money, none. So you've actually lost money. So that's the problem, is that these ETFs will continue to rotate names in and out. It's not a static number of holdings. It's not a static list of holdings. And so from time to time, you could not make any money. And so I just talked to a client like that today with $6 million. And he's like, I'm so frustrated. I've held this thing for 5 years and I made nothing. It's that's a hard pill to swallow for an investor. There's so many things that you could make money on. If you bought a house anywhere 5 years ago, look what it's worth today, right? It's there's just so many things that would do better than GDXJ. So are we going to buy GDXJ as a portfolio manager? Yes, because we have to have that as an anchor within the portfolio. But if someone wanted to do the work, I would just say buy juniors, because you can make a much better return by using a rifle approach and narrowing in on 10 to 20 smaller names as opposed to just buying a basket like that at this juncture. When we do buy GDX and GDXJ is last May and June. If you remember, around May 31st of last year, GDX held that 3240 range 3 different times. And we were putting out notes to clients and saying, if this thing holds, it's going to be a parabolic move up. And it was. It went all the way. I'm not looking at the chart, but I think it went to 45 and change from 3240. So that's the kind of move. That's when you want to own GDX and GDXJs, when you get confirmation. Now, we saw kind of a bombed out move here where GDX went from low 30s to 2883 recently, and it bounced there for one day and never saw below 29 again. So really positive, price action since then. But GDXJ broke before that, as you know, and that broke 41 like butter. So I'm skeptical that we're in that same kind of absolutely all in kind of move right here. I hope I'm wrong, but I just want more confirmation. And I think it's going to be choppy between now and the end of the year. So if it's choppy, my recommendation to my clients is, hey, set those limit orders away from the action, be patient. You're going to get filled on some things because there are people that just will, panic sell a market order into your bid.
So, John, what's your thinking around watching the bottom of the list of companies that get included and excluded from the GDXJ? You said that it's not a static holding, and maybe there's some of our listeners don't understand this. So explain to us your thinking around that.
It's a great question. So if you look at the bottom 5 names, let's say in either of those ETFs, especially GDXJ, because those positions are smaller and more illiquid, they tend to move in and out, meaning that Van Eck, who manages those ETFs, has a series of things that they look for inclusion in their ETF. Okay, that's volume, it's trading volume, it's market cap, it's a bunch of different things, some of which they won't disclose to you. I've tried, but I don't really game that stuff anymore. There was a time I was more interested in looking at those holdings and trying to determine, okay, who's going to get put in and who's going to get put out. Sometimes it's easy to see, right? Because if you look at a New Gold, NGD, this happened. I talked to their head of IR a number of times. They were in and out of GDXJ, I think it was, 4 different quarters in a row. And you can see the volatility on the 3-year chart. It's amazing going into those rebalances. They don't rebalance all the shares on one day. I don't care what they tell you. That's not happening. Mm-hmm. Like they'll rebalance for days going into the rebalance. So you can see, like on NGD's chart, it just kept trending lower, lower, lower when it was getting kicked out. And so I would call them and say, hey, are you guys getting kicked out? And they didn't say yes, but I kind of figured out that was a yes. And so we didn't short it, but then we got ready to pounce on the long side once the selling was definitely over, which means, after the close of the rebalance day. Right. So yeah, there's money to be made there because we made money on all 4 of those trades on New Gold. Like we never lost. I mean, it's interesting when you're on the fringe of their inclusion or non-inclusion,
Mm-hmm. So, John, can you explain to us a little bit more about how you structure your buys on companies that you're looking at? Do you go in at the market? Do you leave orders good until cancel? How do you structure those buys?
Another good question. So, good till canceled are something that, unless I have a lot of conviction, I'll avoid because of what we saw in February and March of 2020. Anyone that tells you that wasn't scary is absolutely lying. Like you can't have good till canceled orders out like anymore. In my opinion, it's just lazy. Unless you're like, hey, I'm okay with, if the stock's trading at 20 cents and I'm out there at, 15 cents, well, it's a huge discount to the current price. I'm okay with that. I'll put a GTC out, but I wouldn't put it out at 15. I'd put it out at 15.01, because that way you're just ahead of the big boy who can't buy in 1/100th of a cent. That's another little tactic that I use that is saved me so much money and got me filled on so many orders over the years, because some broker dealers don't allow you to buy except on the full cent. So that's the tactic that I use a lot. But it's really just, putting out limit orders for the most part, but on an illiquid stock, I'm happy to put in a market order or to hit the ask directly, because I know that, the chance of getting shares in this stock is so unlikely that, sometimes you'll just have someone show up and need to sell, right? I mean, I talked to 2 companies this week where they have big sellers and they're long-term shareholders, but they need cash for whatever reason, right? So it's not like a nefarious party, but it is putting pressure on the stock.
Mm-hmm. So do you look at short interest in a stock, and does it make you shy away from anything?
No, I mean, I do look at short interest, and it makes me buy a stock that's heavily shorted. So AG was a great example of this. We're on multiple podcasts last year saying AG looks super cheap to us. And we didn't like don't like the whole Mexican, government situation right now that they're in. But in talking to Keith last month, I'm more comfortable with that, the CEO. So it's on our radar right now. We don't own any AG, but the reason I did really, go heavily into AG in beginning of 16, as well as last year, was the short interest. It had gotten over 20%. Mm-hmm. And I'm like, this is just some big hedge fund out there that probably got a couple of his hedge fund buddies involved, and they don't even know what they're doing. And so if you look at the price action in January, the stock went parabolic, and that was because of the Reddit Wall Street Bets thing. But that, we sold all of our AG, I want to say between 18 and 1999. There was a huge seller at 20, like massive, and then it broke 20. But again, we took some flack for that. But I said, hey, I know how this trades. I've been trading this stock for 13 years. I'm not going to apologize. Like, this is just, we're taking profits, right? And then the stock went to 10. So, this is what happens in our sector, right? It's boom and bust. You have to be able to sell. And so we try to train people on not being overly greedy, because if you keep hitting singles and doubles, you're going to make money.
Mm-hmm. So when you're looking at how you want to, enter these bids, what the short interest is, can you share with us some of the tools that you actually look at, where the bids are and where the ask is on these different stocks?
It varies. I've gotten 5 or 6 market makers fired in the last 12 months because some of them are just so asleep at the wheel. Like I want to get it filled on a stock, right? And the bid is 9 and the ask is 12, and it's like that every day. And I'm like, who is going to put a market order out there? No one. So you have to sit out there at 0901 and then inch it up, and then there's no activity, and it's like, come on, guys. This is crazy. That was in a good market like last fall. So if it's in a good market, you can imagine what that bid-ask spread is like now. I mean, it's just so hard to get filled on certain things. So my strategy, as I said, is to use multiple limit orders on the buy side, maybe 3. So I'll put something closer to the action, something maybe 5 to 10% away, and then something crazy like way away, like 20% away, just in case we have a crazy seller that day. And that's how I'll create a position is slowly, unless there's something like, a catalyst, right? So like you've seen with, Newfoundland this year, there's just so much going on up there, and it's been a hot sector for the gold, a hot area for the gold market. So yeah, maybe you would be more aggressive with your buys, obviously, in a market where you're not going to get any values. But generally speaking, like, there's so many good values you can have just by being patient. And it's just, that's why patience is a virtue. It's hard to be patient.
Mm-hmm. I meant more, what are some of the actual tools that you use, let's say the software that you're using to look at what the bid and ask is, and how much volume there is at each of these price levels?
Gotcha. Sorry about that. So I have used Thinkorswim in the past, but I terminated that relationship with TD. We've moved on to Schwab, and Schwab has Street Smart Edge. So there's many things like that out there. You can use interactive brokers. Even if you're at a bigger firm like a Merrill, they've got, tools like that you can use. But really just you want to get multiple level 2, bid ask quotes, so that you've got, we call that depth. Mm-hmm. You want to see the depth of the stock. So if you call your broker dealer and say, how do I visualize, how do I get action or eyes on how to get that? If you don't know how to do it yourself, they'll tell you how to do it. But that's important, because then maybe you can see 8 or 10 bids, 8 or 10 sellers on the ask side, and you can see, okay, there's only a little bit of action here, but at this price, there's a huge buyer or seller. So, it helps to, as I said with AG, right? I mean, there was probably like 500,000 shares for sale at $20. So I sat out there in 1999 and just sold everything. I sold the rest of my position because I don't know if we'd ever get through that. That was a big number.
So when you're talking about depth, is there a particular difference in buying shares on the OTC versus the TSX? And do you think one has an advantage over the other?
I am a US based guy, so I don't do the TSX. I don't buy stocks on, the Canadian or the Frankfurt or whatever. I'm always buying in the US ticker. So I don't have any experience on that. I know that, there is some weirdness that happens from time to time. If you've got a big seller, usually in Canada, that might cause havoc in the 5-character OTC US ticker, right? So it's not a perfect science. So if one's down 5, the other might be down 8. It's finding those weird things. And when we do see that, we'll call the CEO and say, hey, does this make sense to you? Like this is like a 3 or 4% ARB here. And they'll say, no, that doesn't make sense to me at all. Like, go ahead and take it. It's like, there's opportunities like that exist. But generally speaking, it's just really, a patient game when it comes to as a U.S. investor like myself. You have to be very patient, and most investors are not. I mean, because look at what's happening around us. Like we said, there's so many things going well that people are just going to be like I think that's one of the things hurting our sector is that the lack of volume is evident. And so like for the average investor who can buy Apple or Tesla like very easily, they come to buy our sector and it might take them 3 days. Mm-hmm. and they're just bored, right?
Right. So how about an exit strategy, John? How do you decide when to exit a position, either because of poor or great performance?
Mm-hmm. So we don't have anything in writing about that. I mean, there is some secret sauce to what we do. I would say that, I'll just say that there's a lot of it is not being greedy. If I'm up 50% on something, I know that's not compelling to some of my peers. A lot of them talk 3, 5, 10 baggers. I've never said those words on any show because that's not what we're in it for. If we happen to get that kind of a return like we did in AG and in 2016, we're thrilled. But that's not what I see day to day or hope for and expect. So, our exit is like, hey, is there a fundamental change to the thesis? That's definitely one of our top screens. That could be, like Caliber taking out Fiore this week. Did that really make sense to me at a 44% premium in this market? Not really. But would that prohibit me from buying Caliber in the future? No, because I like what they're doing and they're smart. But I'm not buying it here yet. I want to see that it's not going to have some additional selling pressure due to the takeover, right? To sell, another screen that we would use is just using the phone. And if we hear weird stuff from what we're hearing, let's say there's a news announcement, right? And then the CEO is getting really defensive with me on the phone. That's not a good thing. I mean, like that's something that, as a former analyst, I'll try to sniff out problems and ask some difficult questions of those people, because I've been very open with all these CEOs that we're not going to be there for 10 years. We might be there for 2 years, and we want that relationship to be a good one, but we have to have an open line of communication. And so if we don't get that, or if we get someone who's kind of argumentative, we're just, we're good once or twice with that. But, then if it becomes a pattern, we're going to be on our way.
Mm-hmm. So as you mentioned, there's so many different opportunities right now. How are you evaluating energy equities? And, that's a sector that seems to be soaring right now. So how do you contrast that with the gold equities?
Yeah, it's been hard. I mean, I wish I had more in my energy portfolio existing in terms of a position, in the last 3 or 4 months. I got pretty cashed up in late June because I was up over 100% year to date in my energy portfolio, and I still am. So, that's positive in the sense that we've outperformed a lot of our peers. But at the same time, I'm heavy cash right now because I see oil just going crazy and I don't want to chase it. I'm not a chaser. And that's part of the problem is like, I don't own any lithium right now. I wish I did. But lithium just went berserk and went hockey stick real fast. So I like to get behind stuff more like copper, where there was like a slow ascent. It had resistance. It felt resistance at those levels, but then it took it out after multiple tries, and it gave you some time to get invested. Mm-hmm. Oil's just been going up for like weeks and weeks, right? So it's like, I'm gonna hold off a little bit and just stay in cash, and then bottom fish some stuff. For us, we saw some news today with Tesla about the EV battery market. We've followed fuel cell stocks for 21 years, believe it or not. So, we look at something like FCL or FCEL in the States, fuel cell, not our favorite name, but, it held that $6.90 level here multiple times in the last few days, and it just took off today after it held it again. So that's the kind of stuff where we're like, hey, we can make 13, 14% a day if we're smart about it. And there's a lot of coiled springs out there in certain areas of the market.
Mm-hmm. And as you mentioned, copper, it's nearing, if not at an all-time high right now. We're seeing lots of energy in this sector. Does that make you look at copper differently? And as you said, like with oil, when it's at this all-time high, you don't want to chase it?
I'm happy to chase copper because, and when I say chase, I'm happy to put bids out there that work close to the action and pay up a little bit here and there, because some of the copper juniors just have done absolutely nothing. Some of them have done really well, but some of them have just done so poorly here. And it's just shocking to me that you can still buy these things so cheaply. So part of our strategy has been copper juniors and mid tiers for the last, I'd say, 18 to 20 months. We got really heavily into copper late May of last year, got really heavy in July of last year, as we started to see it break those key $3 plus kind of levels. And then when it broke $4, we were like all in, that was like the big resistance level. But now we've approached $5 a couple of times and failed, but it's like $5 copper would be ridiculous, and so the way to play that through just trying to track the price is CPER. That's the ETF that tracks copper price. COPX is the ETF that tracks the larger names in the copper space. And I don't know of anything in the junior space. There will be something if we keep breaking out like this, right? They'll just create something. But that would be compelling. And most of our time is spent buying the copper names no one's ever heard of before. And we've made really, really good returns in the last 12 to 18 months on these names.
Excellent, John. Is there anything else you'd like to chat about before we wrap up here?
Well, we started a newsletter late July. It's called the Feneck Commodities Report. And I did that begrudgingly because I've been asked to do this for about 5 years and I've resisted because I know it's a lot of work and I don't have a lot of free time. So, I'm starting out doing it 2 times a month instead of 4. But we've lowered the price, hopefully in accordance with that. And I'm happy to work with people. Like if they say, hey, look, I've got 50 grand, I don't have $60 a month or whatever to buy your newsletter, then okay, let's figure something out that works for you. I mean, I'm happy to work with people. We just started this. And so we're trying to capture that, smaller investor under 500K that needs direction, but is not able to buy our alert system right now, right? Because that's more capital per month. And I get that. So we started that, and the format is basically market commentary at the front end, and then commodity and focus after that per issue, where we'll dig down into something like silver and say, okay, it broke 22, but it did that for a very small period of time, and it's been in an uptrend since. Here's how you can play that, and then also here are some names that we like within that space.
Perfect. Of course, that's available at fenneckconsulting.com, and no Twitter for you, right?
Yeah, I have a Twitter. It's gosh, you're putting me on the spot here. I think it's at Feneck with a capital F, Consult E with a capital C, CONSULTI, and then the number 1. So maybe we can post that in the show notes.
Yeah, I was just going to say we can find that and put it in the show notes for our guest.
Yeah, I am deficient when it comes to social media. So I'm old school. I pick up the phone, I get emails, and I need to work on that.
All right, John. Thanks so much for your time today.
Thank you, Tom. Appreciate it.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.